Welcome everybody. This is the webinar Trading Psychology and Discipline with Thomas. I'm Thomas. I will be the one hosting the webinar today. We will be discussing regarding different things that you should be familiar with when trading with our platform. Now I will start the presentation. So first of all, my name is Thomas Megan. I'm Senior Account Manager in AvaTrade. I've been working in Ava for the last few years, and during that time, I've had the opportunity to work with many traders and assist them and explain them more about our platform and how to use it, and the major things that they should be quite familiar with when trading. So I will be sharing with you from the knowledge I've accumulated through the years, and I hope that it will be helpful for you guys. We will do a risk disclosure, any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, recommendation or suggestion. CFDs are complex instruments and come with high risk of losing money rapidly due to 57% of retail investor accounts lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your capital. Okay, so now we can start the webinar. We will be discussing today about trading basics, platform essential, opening and closing position, pending order, stop loss, take profit, account type and benefits. So now I will go to show you the WebTrader page. This is the main page that you will be getting yourself familiar with when you log in to our platform. When you click here on the three lines on the left top, you will be able to see my accounts. And if you click on accounts, you can see the different account that you have with us. Below you can see the demo. If right now you don't have a demo, I suggest that you will click add an account and set up a demo account. So you will be able to execute positions on a demo and experiment live while we are on a webinar to get yourself more familiar with how things look like. And now we go back. This is the trading platform where you will be able to execute positions from. And you can see it is divided here by different sections. You have hot, most rising, most falling, most buying, most selling. If you click on that, for example, it will give you US 500, US 30. And here you can see different things regarding, for example, the chart of the US 500. Also here, most rising. And you can see below Forex indices, crypto, commodity stocks, and different type of instruments that we offer to trade with. Okay, so we start first of all with the basic. What is a CFD? CFD is a contract for difference. It means that you're trading on a value of a certain instrument, indicating if you think the value will go up or if you think the value will go down. You're not actually owning any instrument. You're only trading on the value of the instrument, and you have the ability to indicate if you think the value will go up or if you think the value will go down. you can benefit from both sides. A buy position is if you think the value will go up, and a sell position is if you think the value will go down. The profit and loss will be determined if it's a buy position, and at some point the price goes up, so you make profit. If it's a sell position and the price goes up, then you lose money. That's the basic difference between the buy and the sell. The leverage basically represent how much margin is required to open a new position. Some of you are based in EU, so the leverage on your account is up to 1 to 30. According to EU jurisdiction and regulation, we apply for, and some of you are outside of EU, and the leverage will be up to 1 to 400. So as I mentioned, ability to buy both way, buy or sell overnight interest. You will see soon. I will share more information. Basically, when you hold a position overnight, you will be charged with the overnight interest, but it's not always negative. Sometimes it's positive. I will show you soon how it looks like in terms of the interest. There is a difference between a buy position, sell position, and it varies between different instruments. Risk involved with trading CFDs are a complex trading instrument. A profit and loss basically determined by the exposure you set for the position, by the lot size. I will be sharing with you shortly. Here, this is a small introduction to the website, so you can see. So you can go to the website avatrade.com, and this is the homepage before you log into the website. Here you can see some different things that we have on the website. It is divided by different sections. For example, products, and it's giving you what is Forex, how to trade Forex, different kind of things that you can learn from regarding the platform. Then you have Academy, and you have here also different things and courses that you can learn from. The type of platforms we have: WebTrader, other options. We have the app, and here the MetaTrader 4, the MetaTrader 5. These are the main two platforms that we will be discussing today. We have AvaSocial, which is an app that you can download and you can copy other traders. And we also have WebTrader, which is also a copy trading service by a third-party company called WebTrader. Here you see crypto. Trading information, this is an important page I wanted to share with you today. If you click on trading info, and then you click financial instruments. By the way, you can also do the same thing that I do. You can open a new tab, go to avatrade.com, and here you can open the new order, the trading info page, and divide it. It's divided by different sections. If you want to trade on something specific, you can also look it up here. And then you can either open it. Before we do, you can see here it is divided. So again, we went to trading info, financial instruments, and you see divided by different sections: Forex, indices, commodities, crypto, stocks. Now we look here, you see the instrument on the left, the leverage. Again, it represents the amount of margin that is required from you to open the position. If the leverage is higher, it means that you need to have less margin to open the position. Margin, it means you need to have less money, less capital to open the trade. Euro dollar, for example, here it's 1 to 400. This is for our clients outside of EU. The margin is 0.25%. If the margin is 0.25%, the leverage is 1 to 400. The spread base spread is 0.8, but we have floating spreads. Floating spreads, it means we have the base spread plus the market spread, which means that the spread can widen and then shrink back to the original spread. And if we click here on euro dollar, this is the page where I wanted to show you. You can see, first of all, the high and the low, but the things here, overnight interest. As I mentioned, it can be positive or negative. So specifically for sell position, you see this is positive. What it means is, it means if you open a position overnight, you will not be charged with a negative commission. You will be charged. You will be credited with positive, according to this percentage. And in the following webinar, that will be more in depth. I will elaborate more about the calculation of how to calculate. If you want to hold a position for a week or for a month or for a year or a few years, I will share with you in our next webinar. Basically, each webinar that we will be doing, I suggest that you will watch the previous webinar to get familiar with the material that we have discussed in the previous webinar. So because we're going to build up the information from a webinar to a webinar. So I will not be able to explain everything I explained in the previous webinar, but today I will, because we are starting out. So this calculation, you will learn more info in the next one. Then we have trading hours, we have the platform symbol. This is also important because some instruments are not available on MT4. They are only available on MT5. So you can see when you click, for example, on stocks, let's say Groupon is available on both. But some instruments, we go back, let's say we go to page 5. And you can see here MT45. Also in, now you can see the instruments starting from page 7 on stocks. You can see the instruments that are available only on MT5, which means that if you have an MT4, you will not be able to trade on these instruments. So you will need to click here. This is the WebTrader, by the way. Some of you may see the other page, the white page of my Ava, and this is the WebTrader. So you can either add an account here, or do you add a new account? You click on the 3 lines, my account, accounts. And you choose add an account, real account. And then you have CFD MT5, and you click submit. After choosing the base currency that you want, you can also set a demo to practice if you wish. That's how you open an MT5 account in case you want to trade on instruments that are only applicable for that. So now we will continue with the presentation. Okay, this is the page that I showed you where you click trading info, financial instrument. This is the page where you can see over here what is the overnight interest. This is daily. Now, this is the WebTrader page that I will be sharing with you. Okay, so first of all, when we go back to the website, you can see on the top, this is the page where you can see your account and the balance, free margin, used margin, profit, equity. The numbers here will change depending on your open positions or your closed positions. So the balance represent your closed positions. Every time you close a position, the balance will increase or decrease. It does not represent your open positions. The free margin, it represents the amount of money you have in the account to open new orders. So in order to open a new order, you need to make sure the free margin will be higher than the margin impact, which is the margin required to open a trade. Then we have the equity. It represents the real value of your account, including your open position. So it means if you close all of your open positions, you will be left with the equity. That's why this is the real value of the account. So here we can see everything on the top. Continue the next one, used margin. This represents here when you place the order, you will see the used margin will appear with the amount of margin that was required to open the position. So now, let's say you want to choose an instrument, whatever you prefer. For example, gold. Once you click on it, you will notice the new order page will open on the right side of the screen. Okay, this is the page where you can place order from using the WebTrader. In the future, we will also discuss how to open positions and how to set up and log into your account using the MetaTrader platform. So over here we have the buy price, we have the sell price. The difference between them is the spread. We have the lot size. The lot size represents the position size that you want to open. If you want to open a smaller position size or a bigger position size, the profit and loss per each point the market is moving will reflect accordingly. So the minimum lot size we have 0.01 lot. And then the margin impact, if you are in EU, you will see a bigger number than that because of the leverage is smaller, okay? As you can see here, the margin requirement is 20. So if I want to use the whole margin that I have, you can see system will tell you once you change the number here, 4.4, this is a position I am able to open if I want to use all my margin. But if I change it to 4.5, I will not have enough margin. You see 9,358, this is the margin required to place the order. I will not be able to click buy. But if I change it to 4.4, my free margin is 9,242 minus 9,150. It's bigger than 0, so I can open. So once I place the order, what will happen? You can see the used margin. This is the amount of money that was required to open the position. So this represents that if you close the position, let's say I want to close the order, I go to positions. And then I click on the X if I wish to close it. If I wish to edit, I click on the pen. And I can add a take profit or stop loss. And when I click on the X, I'm also able to close a portion from the position. So if I don't want to close all the trade, I can close, let's say, 1 lot or 2 lots or 3 lots or 0.01, whatever amount I want. So specifically here, let's say I want to close two lots. I click close position, and you see what happened. The free margin increased and the used margin increased. This was 9,200. Now it's 4,990. And the equity is 9,300. So this represents actually the amount of money I have in the account if I decide to close the trade. So for the sake of the example, now we have another position open. Let's say we close it. I want to close all of it. I click close. And on the history, I will be able to see the profit and loss that I have. So for the two positions I have open, you can see I made $2 and I made $60 on these two positions. I can see the details, open time, instrument, profit and loss, the side, the buy or the sell amount, the open price, the close date and time. So we go back to the new order page. I wanted to show because this is something very important that traders not always necessarily know how to navigate throughout the free margin and how to increase the margin, how to reduce it, and how to trade on a also smaller exposure or a bigger exposure. It depends on your risk appetite. Risk appetite represents how much basically you want to risk, whether you want to risk $10, $100, $1,000, whether it's a 1% from your account, 10%, or any amount that you choose. So the use margin we have discussed, the margin level represent, it's a formula. The main point of the margin level is whenever your free margin is above 0, your margin level will be above 100%. If the margin level, well, you can see it here. Now you cannot see it, but this is for an open position. So if I open a trade, I can see the margin level is 2,234%. So when you are trading with a full exposure of the account, you're using the whole account, you can see that the margin level will be 100%. And if the position is losing, it will drop below 100%. If the margin level hit below 50% for EU, then you will get a stop out, position will close automatically. If it hit below 10%, it will close automatically for our clients outside of the EU. So if I wish to increase my exposure, I see I have a free margin of 8,890. It means I have this amount of funds too. I can open another position. I just want to show you how to, under what scenarios the margin level will be 100% or lower than 100%. So again, we go to nine lot is too big, 5 lot, 4 lot. So 4.5 is very close. 4.4, we don't have enough. 4.3, we are very close, and 4.2 we can open. So if I open the position, you will notice now the margin level is 2,233%. If I will open this trade, the margin level will drop to 101%. Okay? If the position will go into a negative floating, a bigger loss, so the margin level will start going into basically below 100%. the free margin will be negative. So this is important for you guys to know, because if you wish to hold the position, you need to make sure that the margin level is above a certain threshold that you choose. So above 100%, above 150, 200, 300, the bigger you go, it means that you have more time. That if the position will go against you, you have more time to navigate through the account. So it means that if the margin level is higher, you are less likely to have the position closed due to a stop out. Okay? So this is something very important for you guys to know. And as you see, I managed to make the margin level drop below 100% for the sake of the example. Now I go back here, I can close these two positions. And I can continue. With the presentation. So we're here, the margin level. Here you see the formula, equity divided by use margin, multiply by 100. For non-EU, it's below 10%. You'll get the stop out for EU. And for non-pro clients, it's below 50%. The margin increase when you close a position that is not hedged. The margin will increase. Hedging. So I will share with you today what is hedging. This is something that a lot of traders, some people really feel that hedging is something that they like to do. Some people, they don't use hedging. Hedging is when you open a position on the same instrument. One is a buy, one is a sell, same positions on the same position size. I will share with you now how hedging is being performed. Okay, the point of hedging is that the margin that is required to open a position that is deducted on the second position, on the hedge position, the margin will not be deducted. How does it work? I'll share with you. For example, choose an instrument that you wish to trade with. Here you can see, by the way, there is another zero added. So the minimum here is not 0.01, it's 0.001. It's nanolot. That we have nanolot only on NT5, on a selection of instruments, not on everything. So here you can see you have nanolot. Now let's say I want to open 0.1 lot on this position, buy position. Once I click buy, it will execute the trade. You can see your margin is $1,265. When I open a sell position on the same instrument, US Tech 100, the same lot size I open, 0.1, and now I open a different direction, which is sell. You see the margin impact. This is the amount of money I need to place the order. Free margin is, I don't need any margin for this position. Okay. So if I click to open, execute the order, what I have here, I have one position buy, one position sell, the same size, different direction, and the margin that was used only for the first position. The second position is considered a hedge, so the margin was not deducted twice. This is important for you to know in case this is something that may be relevant for you. If you have questions, by the way, feel free to share the questions and I will be happy to answer. You have a button where you can ask questions. So here we go back to the new order page. As we mentioned, the buy and the sell price. Difference is the spreads. We have the lot size. The lot size represents the profit and loss that we have per each point. If we go on a bigger lot, so the profit or loss will be bigger per each point. The margin impact represents the amount of money we need to have in a free margin to place a new order. Now I will be sharing with you a product that called AVAProtect. This is a product we've launched a few months ago, maybe 1 year ago. And the main purpose of the product is that you can get a protection for a certain amount of time. It's better that I will show to you here. Once I close the position, I will share with you how it works with AVAProtect. So AVAProtect is available only on currencies, gold and silver. Whatever we choose, let's say USD, this is an exotic pair. You see, there is more options. So AVAProtect, you choose the duration. Before that, you can choose the lot size. If you choose a smaller lot size, let's say 0.01 lot, this is the minimum, then the price of the protection will be smaller. So you can see here the duration for 1 hour, I will need to pay $1.42 in order to get the protection for 1 hour. What does it mean, protection? It means that if I lose money within that duration, the money will be reimbursed automatically when the duration expires, if it is negative floating, if there is a negative floating. Let's say I just see I got a question. So I understood a question regarding the webinar, the title of the webinar. That was the question. So basically the webinar we're having is indeed trading psychology and discipline, but we are building a few webinars starting from the basics, and then we go deeper into the more psychological side, because when it comes to trading, you need first of all to know what is trading, what are you trading on, and obviously how to calculate profits, losses. And once you know that, then we can go into setting you up with a strategy that you choose how to trade, and then you navigate through this strategy. So this is something I will also share with you today. Once we cover up the basics that maybe some of you don't know. So if we continue on the AvaProtect side, this is also related with the psychology of trading, because this is a product that enables you to set a protection for your position. So you pay $1.42, for example. Here you see the price will change for 1 hour, and within that hour, if there is negative floating of $5, $10, the money will be reimbursed automatically. So how does it work? The money that is required for the protection will be deducted automatically straight away when you open the trade. You need to have the margin to place the order, and that's what is required from you. Okay? If after the duration that you set, after the hour, there is profits, you will not be reimbursed with anything. Reimbursement is only for the losses. Now, if you change the lot size to, let's say, 0.1 lot, obviously the price will be up, will go up. The maximum is 2 days. As we go up with the lot size, the price will be higher. And also, obviously, if the market goes higher against you, you will be protected during this time. So in order to make profit on this position, you need to make more than the price of the protection. Here you can see different kind of examples. One lot, and the duration, 1 hour, 2 days, and then 0.01 lot, 1 hour, 2 days. So what is required? You need a free margin, and you need to have the money to pay for the protection. When will the charges appear in the account? As soon as you open the position, you will be charged for the protection. Your losses will be reimbursed under 2 conditions. Either if you close the trade within the protection period, or either if by the time the duration expires, you have negative floating. It will be reimbursed automatically. To make profit without protection, you need to make more than what you paid for with the AVAProtect. What happens if my position continues after the protection? In that case, you will not be protected anymore, and you can either close the position by the time of the protection ends, or you can just open a new position if you wish to get additional protection. So here we provide a few examples on that. 0.01 lot on gold, 2-day protection cost 39.33, negative floating $100 at the expiration. So you get the reimbursement automatically of $100, and you basically effectively save $60 because you paid $40, 39.33 for the protection. So that's the amount of money that you so-called lost. If we give a bigger example, larger position, so for 1 lot on gold, 2-day protection cost, let's say it's 3,933. If the negative floating by the time the protection expires is 10,000, you will be reimbursed with 10,000, and it means you saved about $6,000 because you only lost what you paid for the protection. Another example with a profit scenario, 0.01 lot on gold, protection cost, for example, 39.33. If you end with a profit of $10, there will be no reimbursement because you get the reimbursement on the loss. Another position for a profit scenario, large position, let's say 1 lot, protection cost 3,933. If you end up with a profit of $2,000, again, there will be no reimbursement because you ended up with a profit. If you have a question about AvaProtect, this is a product that can help you in terms of psychology as well, because when you in advance know what is the amount of money that you are willing to risk, it can assist you with your trading as well, if this is a strategy that may be relevant for you. And now we will touch something that called execute when price hits. It's a pending order, actually. So what is a pending order? Pending order is a position that you open, and the position will not be open until the market reach a certain value that you set. So in terms of the psychology of trading, This is something that can be very helpful for traders who want to set positions in advance, okay? And once you set the position, you know that it will be triggered automatically. So you won't need to go and basically look at the chart and decide where you want to open the position because you already set in advance when the position will be triggered. So I will share with you the example how to set up a pending order. You click here, execute when price hits. You set the lot size, let's say 0.01 for the example. You set the price where you want it to be triggered. Let's say 17.2, for example. And then the position will not be open, but the pending order will be. You can also add a cancel date if you want. Once you click to execute, you will notice here on the order page, you will see that you have a pending order. The position will only be triggered if you have enough free margin to place the order. So for the sake of the example, USDs are $0.01. I need about $2.5 for the position to be open. So when the market reached the point that I set, which is equivalent to the price that I decided to trigger 17.2, then the position will be executed. So if we go back to trading and how to control ourselves when trading, a lot of traders, they have that main issue where they don't really know how to decide when to close the position, when to open the position. And in terms of psychology, it's really interrupting with the way that they are trading because they don't have a certain plan that they set in advance. And even if they do have a plan, it's not written and it's very difficult to follow. So when you do set a pending order, this is a way for you to set up your plan. You open the pending order, and then when you open the pending order, it will be executed automatically. You can also choose to add a stop loss and to add a take profit. So basically, you will know that when the system reaches certain price, it will try to execute closure. Okay, so for example, here you can set your stop loss and take profit with the loss or profit exposure that you want. You have the two columns on the right, the possible profit. On the left, you have a price. So you can either change the price. Let's say I change the price to 17.3 and it's giving me my possible profit. If I change the price of the stop loss to 17.1, for instance, it's giving me my possible loss. Once I click to save the change, I have a pending order that is set. It will be triggered automatically and it will also be closed automatically on the take profit and on the stop loss. Important thing to know about take profit and stop loss is that if the market reach your take profit, it will be closed exactly at take profit point. So some people, for them, it's not really relevant to use take profit, but it really depends on the market. The market sometimes gap from one price to another price. So it happens that it go above your take profit and still the position is closed the take profit. When it comes to stop loss, we do not have a guarantee for the stop loss. So the system always try to trigger closure at the price that you set for your stop loss but again, not always it will be able to trigger exactly at that point. So it may cause that you lose more than the amount that you set for your stop loss. As you will see, if you set a lot of stop loss, you will see that most of the time it will be triggered exactly at the stop loss point. But as you know, the market is volatile sometimes, and it may cause to a stop loss gap, basically. Okay, so that's something you should be familiar also when trading regarding the stop loss and the take profit order. So we spoke today about the pending order and give you the explanation how to set it up, the take profit, and also you see the difference in the profits. So if gold reach 4,100, over here you can see the profit will be $47, and you can see here for one lot the profit will be $4,836, and for 10 lots will be $45,960, and for 100 lots will be 4,560, 456,000. You just click here, take profit, and you can put the values that you want. Now, I'm working Ava as a senior account manager, also an account manager, and I just wanted to share with you today that if you wish to use the service of an account manager, always you can schedule a call with an account manager. Normally, there is a requirement for accounts above a certain threshold, above $1,000, and then you can ask from customer support if you do not have an account manager to assign you one, or contact your account manager and ask him to give you a call, and you can schedule like an introduction call or ask him any questions that you may have regarding the platform and anything that you would like to know. So that's key advantage of having your own account manager, and it's part of the service that we provide here in AvaTrade. So basically today I wanted to share with you many basic things that you should know. Since our time is very limited, we cannot really cover everything in one webinar. So it is important to get familiar with this webinar. So the next webinar, when we go on a different subject, you will already know the basics that we have discussed here today. In terms of trading, I can tell you that I've had the opportunity to talk with many clients throughout the years, and some clients are having difficulty with setting up the right analysis for their position, so they know what will happen to the value of the asset when the position will go up or when the position will go down. This is a key challenge for some of the traders, and some other traders, they have a very big challenge with the psychology of trading. This is the webinar we're having today, and a very important part that we will be covering in our next webinars is how to set yourself with a certain risk management, money management, risk appetite. So when you open a trade, you want to know how much money you are willing to risk on this position and how much money you are planning to profit. And in advance, you can set yourself with boundaries when the position will be closed, and how many positions you want to open a day, and set yourself with a certain organizer that you have a record of all of the positions that you are planning to open and also the positions that you have opened before. That way you can keep a record of yourself and you know whether you did follow your strategy or whether you did not follow your strategy. You can have some different pointers that you mark on each position, whether you open a trade based on technical analysis. So if the price of gold, for example, hit this, I will open a buy or a sell position, and I will open another position at this price, or I will close the position at this price. So you can have it written down and have a clear plan on your trading strategy. When it comes to the strategy itself, it's the trader responsibility to have their own strategy, but obviously this is 2025, and when it comes to strategy, there is a lot of knowledge and information that you can acquire, and it comes to learning. Learning is the most important tool that we traders have, and we need to learn as much as possible to improve our chances and to improve our trading skills. And obviously, if a trader is focusing on a specific niche market, on commodities, currencies, indices, they need to know more about whatever they are doing and whatever they are trading so they can improve their chances to have a successful trading journey. And today we had this webinar mentioning and explaining to you more about important things you should know. I'll be happy to share with you more of my knowledge in our next webinar that we will hold next Thursday. And I hope you guys enjoyed the webinar, and you can feel free to attend the next one after going through this and the previous one. I really wish you guys a successful and fruitful trading journey. And if you are attending the webinar today or you are hearing the recording and planning to attend the next webinar, I advise you to open a demo and to start practicing penning orders and execution of opening trades and monitoring your close positions and setting yourself up with a physical plan, even if it's a simple plan of execution. When are you opening the trade and when you are closing the position? What is your risk management? And you can continue and develop a better plan. So I wish you guys all the best and a successful trading journey. I will see you in the next webinar. All the best. Take care.